All right, we're back on record. Michaela's sharing a homework problem that she had a question on, chapter 4. And these are what? These are the closing. What's the question?
So,
Closing journal entries.
it was for the Kumar Consulting, and then at first
Oh, these are the adjusting journal entries.
we
Got
did the adjusting, and then it was the T accounts.
Okay. And just cross-reference this. And what problem number was it? 14?
Yes.
Problem 2-2. All right. 4-2. Okay. All right, I'm with you now. So then let's go look at your journal entries, and you got those right, correct?
Yeah.
So it was supplies expense, supplies. It was and 1280, got it. And utilities expense, accounts payable, insurance expense, prepaid insurance, unearned service revenue, salary and wage expense, salary and wages payable, depreciation expense, accumulated depreciation, and accounts receivable, service revenue. Great. Okay. So those are the 7 journal entries that are in chapter 4. So, and then we also have the 4 closing journal entries, but your next job was to post the balance. So, and you got accounts receivable 6-1 wrong. So you should have had a trial balance to start with. 6850, accounts receivable beginning balance 7,000.
Yeah, so I just got the date wrong, which I was confused because I thought that was for the beginning balance, looking back at the problem, but because it says on June 1st, but then this is the trial balance as of the 30th. So I guess none of the dates were supposed to be the 1st because I got all of those wrong.
So you lifted the dates and just taking them.
But my main question is the accounts payable section, because that one I couldn't get to add up correctly.
Let's take a look. I want to pull up that trial balance in the textbook. Come on. Okay, so it gave you a trial balance as of June 30th. It says enter the totals from the trial balance as beginning account balances. Yeah, so you needed June 30th for all of those because we don't know what the June 1st balance was. We just know that we had it, right?
Okay, and then so what did I do wrong here on the
accounts payable?
Accounts payable, yeah.
Okay, so you had a beginning balance from your trial balance of 4230. What's the normal balance for accounts payable?
A credit.
Okay. Looks like you had a debit there. Or maybe it just didn't like the date. You've got a debit for 4230 and you've got a credit for 4230. It looks like you put them in on both sides. Okay.
Okay.
And then if you just put it on one side, you would get an ending balance of 4410.
So just on the credit side.
Correct. Should only be on the credit side.
Okay.
And
And then
then
so
date errors, yeah.
why is it that we don't use the June 1st date? I'm a little confused on that.
Sure. So when we do in chapter 4, we do adjusting journal entries as part of the right before we publish financial statements. So in chapter 3, we're doing journal entries all month long. In chapter 4, we're looking at the trial balance and we're saying, okay, this is the final trial balance before adjustments. And then we book our 7 adjusting journal entries. And so when they're saying, what was your current balance in the T account? It's as of June 30th, 22.
Okay.
We're not starting at the beginning of the month and posting every single transaction for the month. We've already done that. Now we're just saying, this is our balance before adjustments.
Okay. Makes sense.
It does. I mean, it's a little more nitpicky than I would be on an exam, but it is important to have the correct date. So,
Okay.
all right.
Thank you.
Let's go look at the multi-step income statement. So I'm gonna
Go.
well, let me share this screen with you guys. All right. Let me take these off. Okay, can you guys see my PowerPoint? Yes or no?
Yep.
Okay. So I'm not even going to take the time to go through these, but we have about 7 purchase, 1, 2, 3, 4, 7. No, that's not right. About 7 total purchase and sales transactions. And the transactions are when we purchase inventory, when we pay the freight bill, if we return inventory to the supplier, and if we pay our bill and the supplier gives us a discount. Okay. So in class and on my PowerPoints, I show an invoice. Judith is selling the calculators. The person whose books we're doing is Jennifer, and we're booking the purchase of $1,400 because it's perpetual. And chapter 5 is using the perpetual inventory system. We only debit or credit inventory accordingly. So purchase transactions, and you don't have to use this word merchandise. You can just say inventory, debit inventory for a purchase. In this case, Jennifer has to pay the freight because title transferred at the shipping point. Again, freight is charged to inventory because it increases our cost of inventory, debit inventory, credit cash. Purchase returns. Jennifer returned 2 calculators, so we just reverse that first journal entry, debit accounts payable, credit inventory. We're reducing the cost of our inventory because we're returning it. And finally, when we pay our bill and take the discount, cash goes out, accounts payable is cleared for the total amount, and then inventory is reduced for that purchase discount, okay? All right. If she doesn't take the discount, it would just be debit accounts payable, credit cash, a journal entry you learned back in chapter 3. Okay. So when we look at the full cost of the inventory, it was the purchase, the freight, less the return, less the discount. Okay. That was 4 transactions. Now we're doing the books for the seller. Accounts receivable, sales, cost of goods sold, inventory, sales transactions. Used to be 2 lines in chapter 3 and 4. Now that we introduce inventory, it's a 4-line journal entry. Here's the return, also a 4-line journal entry because we have to put that inventory back in stock. And finally, when there's a payment, we reduce accounts payable, we debit cash, and we use this new account sales discounts for the discount. All right. And then when we do an adjusting journal entry, which is when you actually take a physical inventory and the books don't match what's, the physical count doesn't match what's in the computer, you adjust it. You adjust inventory up or down, in this case down, and you charge the difference to cost of goods sold. Okay. So I want to show you the multi-step income statement. And we have, again, two systems, one perpetual and one periodic. Okay. So the multi-step income statement is like the classified balance sheet. You have to have some subtotals on it. Okay. So the first subtotal is net sales. So we're going to work our way down the whole statement, but I'm showing it to you by section. In our example, sales is 250,000. We had sales returns of 8,000, sales discounts of 5, and we subtract both of these, and we get 237,000. Again, when you look at your statements for your companies, everything's in one column, and you can do that here too, move the 8 over here and the 5 over here into that one column. You don't have to indent them. All right. The next subtotal, see the pink is the subtotal. The next subtotal is gross margin, or also called gross profit. Okay. So we are given cost of goods sold. It's just a T account. So we just take that ending balance. In this case, cost of goods sold was 142,200. We subtract it from net sales, and that gives us gross margin. So gross margin is a useful number for us in merchandise companies. It allows you to compare two companies together who are in the same level. So we were talking in class, if you were to compare Nordstrom to Target, they're not really comparable. People go to Target for different reasons than they go to Nordstrom, but you might want to compare the Gap or Banana Republic more specifically, which is under the Gap brand, and the Gap and Nordstrom, that kind of thing. You look at their gross margins. How are we doing? Because they're using the same kind of price points and they should have close to the same cost of goods sold. So it's a nice clean number, gross margin. Net income is not a clean number because sometimes companies choose to spend more money in different areas. So it makes it hard to compare the two companies. All right, so I'm showing that net sales number we just looked at, gross margin, and now we have a category called operating expenses. And this is where you list all the normal expenses that go into your operations. So again, if you're Nordstrom, you're going to pay salaries for the people on the floor. You're going to pay all your salaries. You're going to have utilities for the stores and the offices. Your advertising, there will be depreciation for any equipment that you have or furniture. And then we have something called freight out. And you can call this account freight out expense if you want, or just freight out. This cost is different from the other freight we talked about earlier. This cost is if Nordstrom is shipping product directly to a customer, and then it's freight out. And finally, insurance. You add up all your operating expenses, subtract them from gross margin, and you get income from operations. Okay, so operating income is a new subtotal for us in this chapter, and it's really important. It helps us look at what we call sustainable income. This is the income, whether the income is sustainable or not. So that will make more sense in a minute. But essentially, you're saying, how well is Starbucks doing at selling coffee and coffee products? How well is Amazon doing selling every product? How well does the PACCAR company, which owns Kenworth and Peterbilt trucks, do selling at trucks? We have one more category on this statement that doesn't relate to operations. So it's called other income and expenses. All right, so here it is. So here's sales revenue. I just compressed this so that I could show you guys the whole statement here, but you would list all the operating expenses like we did back here. Okay. So here's the categories: other revenue, other expenses. Gains are like revenue, so they go with revenue. Losses are like expenses, so they go here. So here are the four types of costs for that. If you have any account that says gain on sale, it goes in this section. Okay. If you have anything that says loss from whatever reason, it goes in the other expense and loss section. And then interest revenue would be added. Gains would be added. Interest expense would be subtracted. Casualty loss or any other loss would be subtracted. So you can see they had other revenue of 2,700, other expense of 2,000 for a net of 700. Now here's the tricky part. In this example, revenues are higher than expenses. So you're going to add the 700 to the income from operations, and you're going to get income before tax. Okay. If expenses were higher, you would subtract them, and you'd show this in brackets. Okay. Then you're given an income tax expense rate of 20, 30, 40%. Calculate the tax on the income before tax, subtract the income tax, and then you come down to net income. That's the multi-step income statement. And you can see it here. So all the pink rows are calculations. They are not accounts. All the rest of the stuff here are actual accounts that you'll pick up off of a trial balance. Okay. So in this example, I assumed a 20% tax rate. So hopefully I did that right. 20%. Now I have to check myself. But 20% of 20978 should be 4196. Am I good? Let's see. 20978 times 20%. Yep, that's good. Yay. Love it when that happens. Okay. Now I'm not going to ask you to do a single step income statement because the multi-step has such a lot of rich information in it with all the subtotals. But it is easier. You group all the revenue together. Sales. Now these guys were subtracting. Sales returns, sales discount, interest revenue we're adding. So you got to keep track of which ones you add and which ones you subtract for a total of 10,000. And then we had, that's a negative because you had those returns and the discounts, even though you subtracted those off. Total revenue. And then we just throw all the expenses here, even the other expenses. We're still going to come down to the same number, income before tax, income tax, and net income. But we don't get those rich subtotals in between that help us do a better job of analyzing our business. All right, that is the multi-step. Let's see. Can you see my Word document now? Yes. So I want to show you this, the cost of goods sold calculation. Okay. Let's go to that. I want to show. I'm going to jump ahead here. Okay, here we go. So we are now shifting to a periodic inventory system. Okay, you can see that right here, periodic inventory system. And companies use this system if they're not tracking each item. So what we talked about in class on Monday was if you go to a store and they don't have your size, they can look up in the system and see if they can find your size at another store. No problem. It's great. And that's a perpetual inventory system. However, if you go to a store like Home Depot and you go down that one aisle that has the little bitty fasteners and nails and screws, they don't track them by each individual item. Or if you go to a drugstore, often they don't track the individual items that closely, particularly if they have things in the shelves that are kind of, something they pick up and they just sell one batch of and then it's gone. They're not going to set up an inventory tracking system for that. It's a waste of money, but they will just use periodic. And the easiest way to understand periodic is what we already did with the supplies account. With the supplies account, we said, here's your beginning balance. We bought more supplies. Here's your ending balance. How many supplies did we use up? And then we create our adjusting journal entry. Can you guys put in the chat the debit and credit for the supplies adjusting journal entry? Give me the debit and credit for supplies. What does it look like? Or you can call it out. I'm watching the chat. I don't see anything in there. What's the debit and credit? What is the adjusting journal entry for supplies? I'm gonna give you guys 30 seconds. You don't need the dollar amount, just the adjusting journal entry. What do you got? Oh, close on us. The first part is not supplies. When we use up
Supply
supplies,
expense.
debit supplies expense. And then we want to reduce the supply account. So we're going to credit supplies. Good, good, good. All right. And let's go back to that. So that is what companies do. Okay. So they keep track and they kind of just lump all their costs. And then at the end, they say cost of goods available for sale. And they say ending inventory, only 11,850. This 142,200 must be our cost of goods sold. Okay. So question? All right, so let's look at
¿Tienes papeles o no tienes papeles? A la verga, en corto lo que vamos.
hey Connor.
See you.
All right, can you guys see this? This is a beginning inventory, etc.
Yeah.
Okay, thanks, Grace. All right, so we went over this in class, but it's important to know that this is the flow. This is how things flow in the periodic accounts and in all the inventory accounts. So you may or may not have beginning inventory. It might be 0. But there's 5 items. Okay, maybe you guys could come up with a good memory acronym for this. So the 5 items are purchases, and that's an increase to inventory. Then we have purchase returns or allowances, and that decreases the cost of inventory. Okay. Then we have purchase discounts. That also decreases the cost of inventory. And then we have freight in. Increase. Okay. So if we increase purchase, that's a debit. If we increase purchase returns and allowances, that's a credit. If we increase purchase discounts, that's also a credit. And if we increase freight in, that's a debit, right? So if we had a beginning inventory, we'd have 1 plus purchases minus purchase returns and allowances minus purchase discount plus freight in. That's 5 items. Add them all together and you get goods available for sale. So this is like you going to the ATM Friday night and getting $60 out. You already had 20 bucks in your wallet. Now you have $80 to spend. Goods available for sale. And then what I tell students is Monday morning, you go buy coffee and you have $3 in your wallet. You know you spent $77. So we're doing the same kind of logic here. Goods available for sale minus ending inventory is cost of goods sold. And so how does that look on here? Oops, sorry. Beginning inventory is 11,000, one item, plus purchases for 143,900, that's 2. Less purchase returns and allowances, that's 3. Less purchase discounts, that's 4. Add freight in, that's 5. That gets us to goods available for sale. Then we are given, the problem has to give you ending inventory. And then you have cost of goods sold. So you've gone through that whole calculation to figure out cost of goods sold. That is how periodic systems work. So during the year when they buy something, they debit purchases instead of inventory. When they return something, they credit purchase returns and allowances instead of crediting inventory, and so forth. They do that all year. All right, and so these are the journal entries, the same journal entries that we saw in the first PowerPoint, but instead of inventory, we're debiting purchases. We're still crediting accounts payable. We pay freight in cash. That journal entry does not change. It's the same for perpetual system and for periodic. We make a return, we debit accounts payable, but this time we credit purchase returns and allowances. And then when we pay our final bill, debit accounts payable, credit cash, and credit purchase discounts. And then you see all those transactions. Okay. All right. So here's a final journal entry for when you do take physical inventory. So I showed you on the sheet, here's physical inventory, 11,850. Here's where we empty out all these accounts and adjust the inventory account to make it right. Okay. So both companies have to take a physical inventory. You always have to substantiate your inventory. The question is, when do you calculate cost of goods sold? The perpetual system does it all the time. The periodic system does it once a year or once a month, and they have to take physical inventory to do it. All right, Michaela has a question. Can you clarify the difference between freight in and freight out? Yes, I can. Oh, by the way, at the back of your chapter, there's a side-by-side comparison of all of these. Okay, here's the perpetual on the left. These are all purchase transactions. And the color is where it's different. The black color, the black font is where it's the same regardless of system. Okay. So let's talk about freight in. And when you read the homework problem or the test problem, I wonder if you can see can you guys see my board? So, can you guys see this? Yes, no?
Not really.
Okay. And then I'm not gonna show it on the board then. Let's so we have, let's see if I can. I have a picture in my PowerPoints. It's probably better to see it. All right, there we go. All right, here we go. So the seller's here, it travels and delivers the inventory to the buyer. Most invoices say FOB shipping point as your shipment terms, okay? And that means, when does ownership transfer to the buyer? So the ownership transfers at the shipping point, the buyer owns it. That means the buyer has to pay the freight bill. In real life, it doesn't really matter because the buyer always pays the freight bill. If the seller actually pays the freight bill, they're just going to charge more for the merchandise. But it is sort of a mechanical thing of who pays the freight bill. So if the buyer is paying the freight bill, it's incoming freight, it's incoming inventory. And so we say freight in. Well, we still have the inventory. We have not sold it. So it becomes a cost of inventory. Okay. FOB destination, the seller that owns it while the inventory is being transported until the buyer receives it. So the seller pays the freight bill. But the seller doesn't have the inventory anymore. It's freight out for the seller because if that inventory is no longer an asset, that inventory has become cost of goods sold. So there's no inventory to attach the freight to. So it's a selling cost, freight out expense. Okay. Does that make sense, Michaela?
Yes, it does. Thank you.
It's, they're so close, but they really mean different things. So. Okay. So this is super helpful. And I just redid it from the book. So here's the purchases, debit inventory, credit accounts payable if you're doing perpetual. If you're doing periodic, it's debit purchases, credit accounts payable. Freight bill, debit inventory, credit cash. Periodic, freight in cash. Purchase returns, debit accounts payable, credit inventory. Periodic, debit accounts payable, credit purchase returns and allowances. And finally, paying the bill, crediting inventory for that discount. Over in the periodic, we credit purchase discounts. And then here's the selling transactions, showing them side by side. Okay, it looks like I abbreviated inventory there. So debit accounts receivable, credit sales, that's the same for both. If you're perpetual, you have to book that cost of goods sold entry at the point of sale. So we debit cost of goods sold and credit inventory. Periodic, we don't make a journal entry at the point of sale. We do it at the end of the month or the end of the year. Okay. Return of merchandise, sales returns and allowances, accounts receivable, same for both. Again, for perpetual, we have to debit inventory, credit cost of goods sold, because we have to update that cost of goods sold and inventory balance perpetually. But over here in periodic, we don't do an entry because we don't calculate cost of goods sold till the end of the period. And finally, these two entries are the same: debit cash, credit sales discount. Sorry, debit cash, debit sales discount, credit accounts receivable. Now let's go back to the purchases. Here, when they purchase, debit accounts payable, same. Credit cash, same. But credit inventory on the perpetual side, and over here, credit purchase discounts. Okay. So 1, 2, 3, 4, 5, 6. That's 13 journal entries. Okay. And from chapter 4, you had another 11. So that's a lot of journal, about 24, 25 journal entries this chapter. So strongly, strongly recommend you guys make flashcards for all of these journal entries so you don't lose them. Okay, so here's a practice exercise, and we'll do that in class tomorrow. And then I usually say, set this up for perpetual. Now, I don't have to tell you it's perpetual. You should know that, because it's got a cost of goods sold account, and it doesn't have those other accounts, purchases, purchase returns, etc. Here's periodic, and I'm only asking you to calculate cost of goods sold. And now we see the 4 accounts: purchase, purchase returns, purchase discounts, freight in. And then we also need beginning inventory. And then we need to subtract ending inventory. All right, and here's the solutions for both of those. All right. All right, so that's it. And our time is up. Do you guys have any other questions that you needed to go over?
That's all good for
Yeah,
me.
I had a question.
That's great, Connor. Thanks for stopping by. What do you got, Hamza?
Because I have two questions. First, for the project, for what's it called, 4.5. When I'm discussing the strengths and weaknesses, is it fine if I just categorize instead of saying these are the strengths, these are the weaknesses? Can I just say this is how the sales have been, compare the two, just given the numbers, and then write analysis on it, and then finally just give an analysis of like Home Depot or whatever has better sales, this current ratio, all this stuff, and then give the opposite as well.
So those sound like the same things to me. So you'd say, what would be your thesis statement, Hamza?
My thesis would be like, for a few reasons, Home Depot is financially more stable than Lowe's. These are the factors I'm going to examine, and then I'd start with sales, and then I'd give you Home Depot sales and Lowe's sales, and then I'd below that analyze the numbers and then say this company has better sales, and then I'd go next the current ratio, and then I'd be like, these are the current ratio, this is the other current ratio, and then analyze and tell you which one is better. And then in the end, I'll just like final thoughts, I'd just be like, oh, these are Home Depot is better in this. Lowe's is better in this and this. So totally, if we look at everything together, Home Depot is better.
Home Depot is stronger, even though the Lowe's has strengths, they don't have as many as the other. So the important thing is, of course, your thesis statement, because then you're telling me what you're going to say. And then when you talk about sales, use the data in your analysis. You know, you can say the sales growth for Home Depot is higher than the sales growth for Lowe's, and they're positionally stronger because they have a bigger sales. I don't know if that's true, but I'm just speculating. So so you want to give a nod to the trends as well as the overall strength of the number.
Yeah. Okay. And finally, about the periodic, right? So for example, in exam, would you tell us calculate the cost of goods sold periodically, and then we'd get the number for cost of goods sold, and then you tell us to create a perpetual with the new cost of goods sold we have. Is that how it's gonna work?
Sorry, I have to send a text really quick to my program chair.
All right.
Okay, go ahead. So start over.
Yeah, so you know how in perpetual, we factor in the cost of goods sold in all our journal entries. So we already know the cost of goods sold, right?
Correct.
So when for example, I was thinking, would you do it like this? And I'd say like an exam, you'd tell us to calculate the cost of goods sold, right? Using periodic, and then we'd find the cost of goods sold. And then now with the new cost of goods sold, we use that to create a multi-step income statement with the new cost of goods sold.
No, the way it would look like this. You'd have the cost of goods section would be inside the income statement.
Okay. That's what I was thinking. So instead of just writing the one place cost of goods sold, we do the calculations for everything, and then
You would, and everything else would be the same. You know, you'd have sales minus sales returns, sales discounts, net sales. And then when you get the cost of goods sold, you have to insert this big thing. And then that you do your operating expenses and so forth. It would all be the same.
Okay.
But you have the statement, yeah.
So do you so I finished all the homework and stuff. So the homework 5.2 is going to be about the perpetual.
The second half of the homework is just periodic.
I mean, yeah, periodic. Yeah, that's what I'm gonna say. So is there any other place or any other way I could do more practice?
Yeah, you can do it on the practice homework.
On the practice homework?
Yeah.
Okay.
So if you go to, let's see if I can find it. you should be able to go to units and modules. Can you see my Canvas page?
No, I can't see anything right now.
The units and
Yeah, there you
modules, the chapter 5 homework part 1 practice, chapter 5 homework part 2 practice.
Yeah.
And then you can do that a couple of times. And it's
Okay.
not a lot of homework, it's just some journal entries. So it was 5
Mhm.
questions. So you can do that.
Okay. All right.
All right,
Okay.
gotta go, guys. I'll see you later.
I had
Thank you
one
so much.
question before you go.
Sure.
So our project, is that gonna be due this next week?
Which project are you talking about? 4?
Yes.
So what does the calendar say? I believe it's Thursday night. Hang on, I'm just waiting for it to come up. Hang on. Yeah, project 4 is just the paper, and that's due Thursday night.
Okay, and that's the group project, right?
Correct.
Okay.
And part 2 homework is Friday night. I can move part 2 to Saturday night if you guys want. I don't mind. If that helps you guys. I hate to put Saturday night deadlines because nobody feels like doing anything Saturday night.
Yeah, honestly, I'll probably be more motivated to do it Friday night.
I hear you loud and clear. All right, okay. And then we have the exam next week. So we'll do a review session there.
Okay, awesome. I'll be ready for that. Thank you so
Awesome.
much.
And you did a great job getting that homework done. I had a late night myself. I was up till 3 doing some grading and some work for committee work I'm on. So
Yeah, that was like the first Halloween I've had where I really had to just buckle down and
I
just
know
not.
it stinks. Oh man. All right. I will see you later. You take care.
You too. Bye.
Bye-bye.